While some envisioned sharp declines in inflation in almost all economies in 2023 at a more dramatic rate than the central bank's consensus, others warn against complacency. So what does this all mean for the stock market? Joining me now to give some context around the inflation narrative and talk to us about the potential price movements, founder of Mott Capital Management, Michael J. Kramer. It's great to have you on the program again, Mike.
Thank you. Thanks for having me again.
So, Mike, there's been a further indication that inflation continues to ease. Now, we're particularly looking at US CPI numbers last week, and it's been a good and profitable week for those long in the market. However, it just seems to me that the inflation is persistent. That narrative continues to go. And do you think this is another short-term bull rally and an extended bear market? What can traders make of this?
Well, I think it's certainly questionable as to whether or not we're in a bull or bear market at this point, because again, we've seen, a strong advance off of those October lows. Although I don't think we're at the point where we could actually say that we're in a new bull market. I still happen to think that this is a bull market or a bear market rally.
Right. And, if we look at the labor market, and particularly wage growth, those two remain a risk to any further shift away from the Fed's hawkish stance. A lot of people have said perhaps the peak inflation is behind us, but are market participants being slightly optimistic in pricing just 2 more 25 basis points rate hikes coming in February?
I think they are being too optimistic. The CPI inflation swaps actually suggest that we're going to be at a 2% inflation rate by the time you get to June or July. And, the inflation swap market was also looking for the inflation rate to be at around 3% by this time last year. So the market has tended to be a little bit too optimistic in general. The other question, obviously, is that if we have peak inflation, that's totally fine and normal. We would hope that it would start coming down at some point. The question is does it get stuck somewhere along the way? And the tight labor market sort of suggests that maybe it will. Because again, the dynamics of the labor market has shifted here in the US. There's just, if you kind of look at the number of people that are not in the labor force going into the pandemic, there were about 95 million people in the US, and that number's jumped up to around 99 million people as of today. So there's about 4 million people that have left the labor force, and those people haven't been replaced yet. And so that really is what I think the biggest concern here is that, the labor market may continue to stay tight and that wages may continue to stay elevated.
Right. So just before we take a look into how this market is positioning itself based on current technical patterns, I know we've just mentioned this, but do you think the bears may have much more control over this market than the bulls think?
I think that may very well be the case, because if we sort of look at where the market is, if you had told me the dollar index was going to fall from 115 to 102 or 103 inside of 2 or 3 months, and the S&P 500 would have only rallied, about 3 or 4% in the course of the last month and a half, you'd be sort of surprised, right? So what this is getting to is this idea that financial conditions have eased an awful lot, a lot more than I think most people realize. And the equity market, although it's up a lot off the October lows, it hasn't really continued to rally despite the continued easing of financial conditions since the middle of November.
Right. From that conversation, Mike, around the October lows, sentiment has certainly improved drastically recently and is reflected already in today's price. The question is whether this situation merits the bullish breakout brewing on those charts. Let's start with the S&P 500. Looking at the bears versus the bulls, I think there's a pretty wide divergence there between the two. Are we facing any positive bias in the market, and what do your technical patterns show?
So, we're certainly at a point where if the market wants to break higher, it can do that. If we take a quick look, you can see the moving averages for the S&P 500 have certainly, improved. You have, a 200-day moving average that's closing in right now on the S&P 500. In fact, we're just about right there as of today. You can see we've just barely cleared it. Although I must add that we also did barely clear it a couple of other times in the past, going back to, March We tested it again in August. We broke above it actually pretty firmly back at the beginning of December, tried to break above it again in the middle of December and failed. And now you can see we're trying to move up above it again. And so when we look at it from that standpoint, the general rule of thumb is that you sell the market when you're rising into a 200-day moving average that's falling. So not really clear at this point whether or not we've gotten enough distance between the actual index and the actual 200-day moving average to make a difference. The other problem that we sort of face here is that there's this long-term downtrend that's been in place now for some time. You can see we started up here, we tested it once, we tested it again back on August 16th. We came up to it again on December 1st. We actually tried to break above it on December 13th and failed. And here you can see a little bit closer. If I just get rid of these lines to make it a little clearer, you can see we're just barely above it again at this point. So again, we really don't have enough information to say from at least a trend and a moving average standpoint that something has materially changed in this market at this point.
Right. From an economic standpoint, just what's happening this week, what do you think is the key factor that will help determine the movement of the S&P?
I think the key thing this week will be Vice Chair Brainard's commentary and speech and question and answer period she'll be giving on Thursday. Clearly she's been sort of the more dovish side of the camp, at least from some of the commentary that I've heard. And so, clearly given her position, given her, position of strength on the committee, being the vice chair and basically the second in charge, and kind of the leader of the doves, I would say, any sort of commentary that comes out of her that's sort of supportive of what Chair Powell has been sort of echoing, I think just really strengthens the hawkish case for the Fed and this idea that the Fed is going to get towards that 5% and a little bit higher area and keep financial conditions tight for a relatively long time. Obviously, if you get some dovish commentary out of her, it sort of will embolden the bulls and maybe make the difference in terms of whether or not the index can get beyond these trend lines.
Right. So, Michael, I love it when you look at the VIX index to the VVIX ratio. What can they tell us about the potential direction of the S&P? If you could show us what you can see now.
So the VIX to the VIX to the VVIX ratio is sort of interesting and something I've been looking at now for a little bit this past year specifically, because it's very different than the patterns we've seen in the past. So the VIX index we know measures 30-day implied volatility of the S&P 500. The VVIX measures the implied volatility of the VIX. And so what I find interesting is that when this ratio is rising, it tends to be because the implied volatility of the S&P 500 is rising at a faster pace than that of the VVIX or the implied volatility of the VIX. And when the ratio is falling, it's an indication that the implied volatility of the VIX is coming down relative to the VVIX, or it can also mark sort of a turning point in the implied volatility structure. And what we can see here is that I have these lines drawn out, and when I add in my Bollinger Bands, what you'll see is that typically when you get to the lower point or this ratio breaks the lower Bollinger Band, it's been in conjunction with a market that's basically been at or near the top of the range. So here you can see in this case, we broke the Bollinger Bands back in the end of March. You can clearly see came very close to the market top. Here you can see again, we broke the you can see again here, we broke the lower Bollinger Bands back in the middle of August, and it again came very close to the top. Here you can see we broke lower Bollinger Bands, and although it didn't call a top, it called a pause in the market at least 2 times. And now you can see again, we're breaking the lower Bollinger Band, and we're also very close to a potential top here, I think, in the S&P 500 with the potential for it to maybe turn lower.
Right. However, at the time being, one of the positives for the stock market has been that beaten down names, particularly looking into tech and growth, has been well positioned and continue to be well positioned to lead the indices higher. We started last week with the big banks announcing their earnings, but it all ended higher, even as some said they are expecting a mild recession. The caveat now is earnings estimates are falling quickly, and the Q4 corporate reporting season is expected to provide a reality check, and I mean, to some extent. Do we expect the fourth quarter earning growth to stall? And what do you think is the 2023 guidance that we get from a lot of these companies?
So nominal GDP growth here in the US has held up quite well. If you look at the Atlanta Fed GDP Now model, it's estimating real growth of about 4-ish%, and it's estimating a PCE deflator of about 3 to 3.5%, which gives us sort of a 7.5% nominal growth rate, which is slowing, but it's a still very strong number. And so what that sort of implies to me is that I think you're going to see earnings come in at or maybe even a little better than expected in this quarter. But again, the question is going to be the guidance and the guidance going forward, and what the companies are really starting to see and how much nominal growth really begins to slow.
So just for this week and perhaps some of early next week, what are some names that you're looking at? And do we see more choppiness in the major U.S. equity indices, particularly around the NASDAQ and the Dow Jones?
Well, the one that I was really most interested in today was Goldman Sachs, because believe it or not, one of the reasons why you've seen such a strong outperformance in things like the Dow and the FTSE and the Australia 200 is because there's been this big rotation into financial, material, and industrial stocks, and they all sort of look very similar in their movements. In fact, if we take a chart of the Dow Jones and we just overlay it with the FTSE 100, what you'll see is rather interesting. In fact, the two charts seem to have very similar looks to them. And so you can see that the Dow, Australia, and the UK have all sort of moved in conjunction, and that's because of the strong sort of the weightings of the financials, the industrials, and the materials in these sectors. Also, Germany and Australia are two indices and countries that are highly leveraged towards China, and there's a lot of interest in the China reopening. And what's interesting about Goldman is that Goldman has actually, because the Dow is a price-weighted index, Goldman actually has driven about 550 points of the Dow gains over the last couple of months since that October low. And so you've seen things like Goldman really sort of help propel the Dow Jones index higher. And so the results that came out today, not really stellar, certainly missed on the top and the bottom. And you can see that the stock is trading lower. And so if you start losing stocks like Goldman and JP Morgan, which reported on Friday, again, I didn't think those results were all that great as well, but the stock did rally. If those stocks start to falter, if you start seeing financial companies sort of start giving weaker outlooks, or their performance of their stocks sort of start lagging because the results weren't as good as expected given the big run-ups, you could actually start seeing these indices like the UK FTSE and the Dow begin to give back some of their big gains.
Right. And do you expect that this volatility will abate in the second half of the year, or what timeframes can you give us at this point?
I think volatility is going to be, remain pretty strong all year. I think there's going to be a lot of back and forth trying to figure out what the Fed is going to do, where the economy is going, if we're going into a recession, if we're going to see a global slowdown. I mean, China is just at the very early stages of emerging out of COVID lockdowns. And so it's kind of premature to determine what their impact on the world and global growth is going to be. And I think given this, there's going to be a lot of ebbs and flows and a lot of back and forth, sort of like what we're seeing now. And I think this general sort of back and forth of that we've seen in the VIX over the last year is going to probably persist for some time longer.
Right. So, I mean, the higher interest rates that you just mentioned, labor costs, the fact that China's come out of lockdown, is putting a burden on these companies, which have perhaps all contributed to, maybe we'll see, but less profits and earnings being adjusted downward. How do you see, or how do recent movements in commodities come into play here?
So commodity prices have been surging recently. You've had oil prices, which are up quite a bit just over the last couple of days, and it almost looks like WTI is very close to breaking out, which could obviously be a big driver of maybe a resurgent sort of scare in the first half of the year of inflation returning, right? You've seen, gasoline prices here in the US begin to show signs of resurgence and kind of coming and moving higher. You've seen copper and iron ore prices begin to really start to move higher again. And, if you start seeing these sort of movements in some of these key commodities moving higher, you have to think at some point you're going to see, shipping rates begin to climb again. Baltic Dry Index is at a low, but you're really just beginning to see commodities move. So, clearly if commodity prices continue to rise, it's going to favor material industrial type names. But at the same time, it's also going to probably create a scare of the return of rising inflation rates.
Right, and just on crude oil, natural gas, I mean, two very much traded commodities at the moment. What levels are you looking at on each?
So on crude oil, I'm trying to focus mostly on this $80 level, because if we can clear that level, I think there's probably some room to run, maybe all the way back up to around $90 a barrel. And on natural gas, that's obviously been hit very hard recently, but you can see it's at the very bottom end of the trading range here around $3.50. And you can see we're very oversold. So if natural gas is going to stop falling, this is probably the spot it's going to. And if you're going to get any sort of retracement, you have some gaps obviously to fill up into the 4 to 4.5 range.
Right. I want to shed light now on European stocks, which many are saying are probably a better bet than the US in 2023. Well, funny they should say that, because the FTSE 100 has an excellent run from the October lows, has meant that much good news has been priced in already, and now is within sight of its all-time highs. With UK CPI reading coming on Wednesday, are we expecting to see further easing in inflation? What could that do to the FTSE? Could we see make it headlines again?
So like the Dow, the FTSE is very similar in terms of the weightings of, financials and commodity driven stocks. And so I think as long as, you continue to see, strength in those sectors, you could probably see the FTSE continue to rally. But the FTSE is also getting very overbought at this point, with RSIs that are touching, 74, 75. And, it really becomes a question of how much further can it rally, because all of a sudden, once you sort of get past this 2018 high of 7,900, there's really nothing stopping it, because there's no more real resistance there to go. And if we sort of just try to think about where it could go from an extension sort of standpoint, you're talking about, an index that could maybe reach 7,900 and head towards 8,000.
Right, and so Wednesday's reading, again, as you said, the data probably doesn't give us enough there, but in terms of interest rate hikes for the Bank of England, do you think it's fair to say that the next one could be 50 basis points, 25? What would be fair in that?
Well, the market's not really sure. It's pricing in potentially, 1 to 2 hikes there. Currently, it's at a 1.75, so right in between. It's not really determined whether or not you could see 1 or 2. The market's pricing in those odds. So obviously the CPI data on, this week is going to determine whether or not you get 25 or 50. But I mean, overall, you're looking at potentially another 4 rate hikes, at least based off of market pricing, before all is said and done.
All right, and moving into currencies, the pound was getting very close last week to breaking above a downtrend. Now, we did see a positive momentum there. So could we see the pound continue higher in the near term, or is it starting to lose strength?
It looks like it's still got a lot of momentum on its side. It certainly has rallied a lot since those lows following in mid-October. But, again, I think a lot of it's going to be determined upon, where we are in the interest rate cycle overall. Is the Fed close to being finished? If it is being close to finish, then maybe that means that the pound can continue to strengthen, because maybe the BOE still has much further to go. If you look at the chart overall, you can see that this really is the key level, 120, 124 or so on the pound, because if you break above that level, then you have much further room to go, maybe 126, 127, with the potential to even go back to 130. Clearly, if we're not able to get past that and we begin to trend lower, because at this point we do have what looks to be a low and then a lower high, we'd be watching the 118 to 119 level for a potential breakdown to about 113.
Mike, it's always a pleasure to have you on and to speak with you. Thank you for all the insights. Michael is the founder of Mott Capital Management. Thank you for joining us.
Thank you for having me today, and see you soon.